I want to kind of shift it away from M&A ever so slightly and toss this question out to Jesse. Again, we talked about the vast majority, I think it's fair to say, of what we're talking about here, the mutual fund registered fund participants are not going to be sellers nor buyers. But they have to respond to all of the factors that we've been talking about this afternoon in terms of addressing it. You know, terrible fee pressure, consolidation, wolves at the door, et cetera, and they've got to respond. They've got to take action in some fashion. Otherwise, they're not going to survive. Simply. So Neil mentioned one situation in terms of adoptions, sub-advisor, advisor, how you could take some money off the table as one structure. And Jesse, again, from your perspective, you see it again, whether it's series funds, whether it's different outsourcing arrangements, whether distribution platforms, in terms of how folks that are out there looking to reduce their expenses, increase AUM in some fashion, joint arrangements and the like. Maybe you can comment on that.
Yeah, absolutely. There was a survey that came out, I think over the summer, that said 75% of asset managers will be looking at M&A activity over the next few years. I mean, that strikes me as somewhat high, but based on what we're saying today, maybe not. So obviously there won't be that many deals that happen, and there are a lot of reasons why managers may not pursue M&A activity, or if they do pursue that activity, those deals won't come to fruition. But what that tells me is almost every asset manager, or majority of asset managers, are looking at ways that they can improve their business, improve their product suite, make their business more profitable. And so, to Bob's point, M&A may not be realistic for those managers, but there's still things they can do to create operational efficiencies and help grow their business and hopefully launch new products. We like to talk at Ultimus about total cost of ownership. You probably heard that term before. And what we mean by that is, for each manager, making sure they're getting the most value that they can out of their business partners and out of their key service providers. So are they overpaying for their services? Are they getting what they want out of their service providers in terms of their fees? Are there hidden costs associated with those services? Are they truly offlifting everything they can to those service providers to create less of a burden on their own staff, so that their own staff can focus on things like M&A activity, transactions, and launching new products. So we think that's incredibly important for every manager to take a look at who they use for business partners, who they use for vendors, and who they use for third-party providers like Ultimus. At Ultimus, we are big on series trusts. Series trusts maybe aren't for everyone for various reasons, and I know Neil has a perspective on that. But we like what the series trust model offers a lot of smaller managers, in that it allows them to focus on their strategy on managing their fund, and the governance structure is handled by someone else like Ultimus. So it's our governance model. It's we're the sponsor, we have the board, relationships with the board, we have all the other key service provider relationships, and it frees up the manager to focus on simply managing their fund and trying to grow their fund. As Bob mentioned, we see a lot of clients doing either strategic partnerships or ventures. Certain strategic sub-advisory relationships, as Neil said, is something that we've seen. There was a deal that was announced last year. It was a strategic venture with a traditional asset manager and used an alternative manager as a distribution partner in a joint venture. So we're certainly seeing some unique and creative ways that traditional asset managers are trying to access new asset classes and get into new spaces. Another thing that we're seeing a lot of is back to ETFs, mutual fund to ETF conversions, active ETF conversions, and also SMA conversions. So Ultimus was involved in a deal earlier this year where a relatively large asset manager had two mutual fund strategies and hundreds of SMA accounts, and they converted those two mutual funds and all of their SMA accounts into one ETF product. So it got them into the ETF space, which is where they wanted to be, but it also really benefited them from an operational standpoint. To maintain and service all those SMAs was not optimal to them from an operational and a resource standpoint. So it really created a lot of operational efficiencies for them, and they also saw it as a benefit to their shareholders because of the tax benefits, the transparency, and the liquidity that ETFs have to offer. So there's certainly opportunities out there for managers, smaller or mid-sized managers, or managers that maybe can't or won't do M&A activity, to launch a new product. And I think a lot of that is based on selecting the right vendor and the right partners and making sure that you have a good team and good service capabilities around you.
Just on your last point, we're seeing a lot more RIAs or wealth managers that are traditionally open architecture beginning to get into their own products, and having ETFs as a vehicle essentially to really move some of their SMAs into their own cooking, working with an ETF issue provider, white label provider, which stands to benefit firms like Ultimus and other white label ETF platforms that are agnostic and do not do their own manufacturing, but are really service providers to the sector. And that's an ongoing trend with wealth management firms really partnering with these white label firms. And so I see that a lot happening in the ETF world.
Well, let's just pursue that for a second in terms of, again, getting back to the kinder and gentler SEC that we have on our hands today, is that, again, if you're talking about basically developing more in-house product, and it has benefit in terms of algos, et cetera, that you can control the ingredients that go into different products. I couldn't agree with you more. I wonder whether the SEC over time, looking at that trend, will say, you know what, this is inherent with conflicts of interest, and we don't care about algos. We just see that as a problem. We'd almost prefer to use third-party product for that particular application because that doesn't have the same level of potential conflicts.